Welcome, everyone. This is the One Point Podcast, and I'm Rohit Yadav. Today, we are covering investing into private markets from a fund of fund perspective. And to do this, I have Joel Sandhu joining me today. Joel is managing partner and co founder of TopTier Access. What is highly relevant for our discussion today is that TopTier Access is backed by Belgian family offices. So we'll try to capture this family office LP perspective as well, and we'll bake it into the conversation today. Joel, thanks for joining in.
Thanks for having me.
So, as a first question, can you explain what top tier access is all about and what strategies are you investing in currently?
Yeah, sure. So, like you said, the genesis of the idea was really seeing the mismatch between how family offices were allocating to private markets. There's obviously a huge appetite for families to put money into private markets, but when we surveyed the landscape, we just thought that the current solutions weren't necessarily always optimized for families. So whether that be on a fiscal perspective, which is very relevant, sort of Belgium and a lot of European geographies, but then also just from a portfolio creation perspective, from a fee perspective, all of these different things, we basically took a look at the industry and took all the stuff away that we didn't like, and that was how the program was born. So shall we say?
Okay. And so you invested, if correct me if I'm wrong, you invested into, or you looked at the VC space from a fund of fund perspective. You moved away from it based on the risk return. Maybe you can explain it a bit. And you are right now focused on buyout space and so on. So
Yeah.
why did this move away from VC into buyout come into play?
Yeah. So just to clear up any misconceptions, it's not that we didn't start out as a pure VC house and then move into buyout. We were always doing buyouts. And at the beginning, we were also sort of allocating to a couple of VC managers. Look, I think we did a few investments at the beginning into VC managers. Whilst it's clearly obviously a very interesting space, what we fundamentally saw, what we're always trying to build is a programmatic approach. So with buyout, what we do is invest into 5 managers per year as a sort of ongoing program. We raise a new fund every 2 years, but really how we're positioning this is your buyout allocation in your portfolio. You get like a wine vintages, you get like your 5 managers per year. And that's a little bit how we're trying to design it. If we looked at sort of the VC space, access to the very, very top managers is obviously it was very difficult to consistently do that across the years. And so from our network and from our sort of expertise, we were confident that we could obviously fill a buyout portfolio with best managers in the world. Less confident that we could consistently do that on the venture side. But then also, I think there's 2 ways. There's an investment hat that we wear, but there's also the commercial hat as to what we see, where we see the appetite. So the appetite there is appetite for venture, but it comes in quite different forms. So on the one hand, a lot of families, they want to do sort of direct venture, or they're backing whatever, something that their niece started, or local venture plays, which is fine, and it's almost seen as a bit of an ecosystem builder from their perspective. Okay. That's kind of one piece to it. But then also, if you look at it from that investor hat, from a risk return perspective, if you assume that you're going to hit the median of the industry, for us, the risk return of buyout is much more appealing than that of venture over time, in terms of like what we can replicably allocate to. Most venture managers don't go above 2x. You have a very high loss ratio, and the Pareto chart looks quite. It's 1 or 2 big winners. That's the design of the whole asset class, which is fine. I think what we basically look at is if we're doing 5 managers per year, we want to make sure that there's as little risk of capital loss as possible. So that's fundamentally, it's going to be in profitable companies. It's going to be in replicable processes. We're not necessarily looking for a new market creation. It can be boring, a stable business services, for example, which then create a nice backbone of exposure to those private markets. So that was our logic. So from an investment perspective, we're more comfortable with the risk and then the potential upsides, because you can get very good upside in buyouts if you're in the best managers. And the downside obviously is far lower than in venture. But then also from a commercial perspective, we saw that it was a more unified need or desire for buyout fund of funds rather than venture fund of funds. So that's the 2 considerations, I guess, as to why we then now are laser focused on buyout, both mid-market and low mid-market.
I think you captured it beautifully. You mentioned the investment aspects of it. Obviously, the last couple of years plays a role into how venture has evolved, and some LPs are not so, let's say, enthusiastic about some forms of venture investments in some areas, and the commercial aspects. I would love to dig deeper into the commercial aspects. So you mentioned from the buyout perspective how you want to invest within the vintages and so on, and everything sounds fine. However, from the family office perspective, do they come to you? Do you hear such conversations and they say, hey, you know what? We right now just want exposure to buyout. Are they so specific with respect to an asset class and understanding what the features of an asset class is? Or are they just discussing with you in terms of returns and risk? So that's the thing that I want to capture here.
Look, it's a sliding scale based on the sophistication of the underlying family office.
Okay.
That's basically, so that's a bit of a rubbish answer to your question because there is no answer to your question. But look, it really depends on the family office. So what I would say is on venture and on buyouts, I think that there's a typically kind of a misallocation. So the typical cycle that you've seen with a lot of family offices, I see it a lot of the, look, we're obviously we're working a lot in the Middle East now with Middle Eastern investors as well. And I see them going through a similar cycle that I saw here maybe 5 years ago, which is a very big desire to do direct venture capital investments. So, like there's an interesting startup community. They want to get involved. They do some 50 angel checks or whatever the number is, and maybe do a Series A if they've got decent partners. And they quickly realize it's very difficult to make money in venture capital unless you're very, very specialized in it. And so then that usually you'll see then the tide turn. They go, oh no, we hate venture, everything to do with venture. Let's do Blackstone and KKR because there's the underlying companies have 500 million of EBITDA. So then there can be a bit of a reversion away from that into also not the best of buyout, which is the mega caps who are just you're not going to lose money there, but you're also not going to knock the lights out. So I've seen the pendulum switch to people wanting just a bit of stability. They don't want to have to look at their portfolio and see a bunch of zeros. So I think that's the one way that family offices look at it. But then if I look at it in a different way, the people who are maybe a bit more knowledgeable about the nuances of the asset class, you hear more and more that people are quite scared of stepping into Blackstone. I keep on naming these guys, nothing against these guys. I don't want to, but just these mega cap funds. You hear more and more sort of reticence from families about going into it. Not all the time, and we're confident that you can still get returns with some of that in your portfolio, not 100% of that in your portfolio. But we do see that then maybe the shift has gone from doing a bit of venture in a not the most efficient way to doing buyout in maybe not the most efficient way. And now we see the pendulum swinging. Now everyone's obsessed with the mid market. Us included. So everyone's quite obsessed with the mid-market now. But then to be able to do that, you need someone like us to be able to access these funds that close in one go. So I would say maybe that's sort of the family office landscape from my kind of limited perspective as to what we've seen.
Very interesting insight of swinging along the pendulum. Let's capture your strategic thought process. So you're right now focused on the private equity space. How do you make sure where you want to play? I mean, it's very broad. Private equity landscape is really broad. So you can divide it based on geography. You can divide it based on sectors, specialists versus journalists, and so on. How do you make the strategic decision of which areas you want to play on?
Yeah. So look, what we're doing effectively here is creating resilient portfolios. I think you have to come at it from a portfolio perspective first, and you have to be thoughtful about how that looks. So I'll give you the criteria that we usually use, and then we can work backwards as to why we came to those conclusions. So typically it's 50-50 US Europe. With our Middle Eastern pocket, it's more like 70-30 US to Europe. So that for us basically just reflects the depth of the private equity ecosystems. Private equity, ultimately, you need to have mature ecosystems to be able to make those deals. If you look at a lot of the Asian exposure, there's some very interesting Asian-focused buyout funds, of course. And probably over the next 20 years, you're going to see some really good performance there. But typically, if you look at a platform, the Asia piece is not necessarily outperforming the Europe and US piece. There are examples where that's not true. A big platform, for example, KKR, the Asia piece is tremendous. So they do better there than they do in the Europe piece, which is interesting, but it's not necessarily always the case. So we don't do any Asia. It's just Europe and US is what we focus on. Okay. So for us, capital markets, SME landscape, all of these things, opportunity set of investments and private companies is the best, deepest potential public markets for exits and things like that. So I don't have to explain why Europe and US are leaders in these things. It's just for us, we just bank on that kind of heritage there. And then where we go to there is, look, we want to be diversified. Everyone talks about diversification, but just having 10 funds over 2 years is not necessarily diversified. Really, if I want to pick 10 of the top funds that have been, smashing it over the past 10 years, I could easily pick 10 tech funds that are doing SaaS. Because, if you put like 10 healthcare funds or something, these are the ones that have been, where all the top decile performance is usually be in software. But if I did that, then I'm not going to know when I'm at the top of the pricing, or at the end of the bubble, shall we say.
Mm-hmm.
So what we do is we say that we need a diversity of types of companies, size of companies, and sectors. So we're not going to take a bet on a sector. Typically, we'll probably be 30%, 35% tech, because everyone's in tech. Everything is tech, I guess. You want to have maybe 15, 20%, 25% healthcare. You want industrials, you want business services. Consumer, we're less hot about, 5% consumer, or consumer done in a specific way we like, but pure consumer plays historically are quite cyclical, so we're not huge fans on that. So that's really the thesis there, is to say we're not going to take a bet on a sector.
Okay.
I'm far too stupid to be able to give you a great macro prediction about the next 7 years on healthcare. I'm not going to then say where SaaS is going to be in 6 or 7 years, where these portfolios are going to be maturing. So it's very difficult to make those predictions. So we just want to have a cross section of where private equity is active, and then also I think the final layer here is size and type of company. So type of company, what we mean by that is like a complex company versus a market leader. So I always say, take for example like a software company from Germany that has 10 million of EBITDA. No, there's two of them. Both German software companies, both have 10 million of EBITDA. One has a shareholder dispute and it's growing at -2% per year. One is growing at 35% a year, and they've a rockstar C-suite. Those are not the same company, even if on EBITDA level they're the same size, shall we say? And it's two different private equity funds that will be able to handle those two situations. So just looking at just diversifying by EBITDA of company is not enough. We have to look at the underlying quality of the companies. So that really means we want some complexity, take private, shareholder disputes, succession issues. You want some good to great companies, where company's pretty good, but it needs maybe digitalization or some heavier touch. And then you also want some market leaders. The pricing is going to be higher, but the growth is probably going to be higher. And there, what you effectively do then is you have like a nice diversification of types of companies, size of companies, sectors, and geographies. And that's basically how we build a portfolio.
Awesome. I think I loved your answer on how elaborate you are with respect to the various buckets and the points that you look at. Let's flip this. What are the expectations from LPs when they approach you and they want to invest in your fund of fund, TopTier Access? So do they have like specific criteria with respect to return hurdles, or are they thinking more around risk criteria, like I don't want to lose my money or capital, right? So what are the kind of top 3 or 2 thought processes that they come to you, or top couple of questions that you have to tackle in every LP conversation?
Yeah. Well, if you're talking to a European, the first question is usually about taxes. That's usually like high on the list, which understandable because it has a massive impact on your net returns, fiscality. But look, I think apart from that, it also, again, I hate to use that, it depends, but it really does depend. I think people see buyout as a nice compromise. They want it to outperform public markets. So the performance angle is oftentimes you'll hear the point, like 11%, 12% IRR, like why don't I just stick it in the public markets? And they're right to think that. I've had conversations with a lot of LPs. They say, their large cap portfolio or whatever, their private equity portfolio that they've done via bank feeders is yielded 10, 11% IRR. They've underperformed the stock market by a decent chunk. And then if they put the same amount of leverage on their public markets portfolio, who knows, they would have been billionaires by now or something. So I think as long, the baseline has to be outperformance of public markets. And, like in our underwriting, we use direct alpha and KSPME metrics to make sure that you're at least going to beat the public markets, whatever the relevant index is for that. I think on downside, on the risk, I think people, there is the assumption that buyout's not really going to lose you money. I think that's kind of baked into people's mind. So probably more they're coming at it with, okay, I want to do buyouts, but how do I get the most performing type of buyout? And there's quite a negative, oftentimes buyouts or private equity generally, if you read like the FT or something, it has a bit of a controversial reputation occasionally. It's a very expensive asset class to enter. You're paying enormous fees. Managers are becoming billionaires on the back of management fees. I'm not necessarily saying that's a bad thing, but the image in people's heads are that it's kind of a greedy industry. So I think it's then people want to understand, what are the incentives and what is then the potential upside to me? Because I think more and more as people get more educated about private equity, they're realizing that unless you're picking the managers properly, unless you're in those top performing private equity managers, it can become a difficult asset class to justify because it's, when there's a market crunch, they also get affected, even with a couple of quarters delay. And then oftentimes you don't see necessarily huge amounts of outperformance either. So it's an evolving, really, because this asset class is changing so much and it's quite new in people's minds. I think every year the general vibe or consensus of people seems to change in my conversations with them anyway. So yeah, liquidity is also now like the big elephant in the room when people are discussing PE allocations as well. So I'm rambling now.
Okay, so I just want to focus one more question on this topic of LP and why they are going into this PE asset class and private markets in general. So we talked about return expectation and so on. Is there specific expectations from LP when they come to you that they say, hey, you know what, we just want to focus on this particular area or bucket within the buyout space, or do they leave everything to your discretion and say, Joel or TopTier Access, please take care of it? And how open they are to co-investment opportunities within the space, because some family offices might be actually quite big and they can handle those co-investment opportunities as well. So I want to understand, is that the criteria of investing within an FOF space? Because via an FOF, they get an opportunity to co-invest, and which otherwise probably they might not get.
Yeah. So maybe to splice the question into two. So the first one is around whether they just take it as it comes or whether they want something special.
Yep.
Yeah, I think increasingly what we've seen a lot is despite all of the noises around tariffs and things, we have heard a lot of people. I mean, that might be changing. This was just as Trump got in. So I think the US optimism was very, very high at the beginning. And so we had a lot of people saying, can we just do the US part of the portfolio? So, we have that a lot. And, okay, tariffs and all of these uncertainties are maybe making some people pull back from that. But I still think if I look at bigger family offices, especially European family offices, it's logical for them to think that. Whether it's the correct decision, I don't know, but it's logical for them to think that because oftentimes a lot of their wealth anyway is generated in Europe, and for them it's a good diversifier to be in top funds in the US. So I think that's basically what we see. No one's ever said to me, can we just do consumer, or can we only do business services, or we only want distressed companies? That's, I think, a bit too niche for people to actually want. But yeah, people saying I just want US is something, or we have people saying we just want the low mid markets. That's another thing. So small cap managers. That's also another thing. In terms of co-investments, it's one of those funny topics. We don't put co-investments into our fund of fund. The reason why, because most fund of funds will have maybe 50% of their portfolio into co-investments, which can outperform, can also not outperform. The data on co-investments, obviously, as the data set gets bigger, outperformance just becomes the fee difference. It's an arbitrage on fee, which is significant in private equity. If you're looking at sort of a subscale fund of funds such as ourselves, unless you're LGT and you have right to first refusal, the question always remains, which is why we don't put it into the fund of fund. What is the quality of this deal flow that you're getting? If you're getting something, let's say I write a 20 million check to a fund, and I'm getting a co-investment on my desk, and I'm in a fund with CalPERS, with Mubadala, with ADIA, with Aramco, PGGM. These guys have teams of 500 lawyers who are writing the most watertight right of first refusal side letters in the world. If I'm getting it as a subscale manager, I have to ask myself, why am I getting this? There's an information asymmetry. It's a quick acting thing that you have to do. Okay. And it's basically you're at the end of the line in terms of that. And then let's say then you do have a right of first refusal and you're still subscale. You're probably going to be picking managers just because they're giving you co-investment rights. It's a selling point from the manager. Whereas for us, we don't want to have to make a decision on a manager just because they're going to give us co-investment rights.
Got it.
In any case, what I would prefer is that they do their thing. I don't have to double down on a position where I have unlimited downside. And let's be honest, in buyout, you have a capped upside. Very rarely are you going to make a 20x on a buyout position.
Yep.
In venture, co-investments make perfect sense, but in buyout, you are typically capped on your upside, and then
Okay.
you have unlimited downside. So for us, you're skewing the risk reward of a portfolio by adding too much co-investment in there. It can be additive, and people do it very well. There's obviously very smart people who are doing great co-investment programs, but for us, that's a separate bucket. It's an optional extra that you could potentially drive some alpha with, on the condition that you have quality deal flow. If you're looking at what the big institutions are doing, they're using it as a fee reduction mechanism. They're not necessarily doing, I'm going to do one deal here and one deal here and one deal here to get a bit of alpha. It can happen and it can work, and there are many programs who are doing it well. But those are the NBs and the LGTs of this world who have 900 fund positions and a 20 billion a year program. So that makes sense. But for subscale local fund of funds, for us, it's more difficult for us to get comfortable with that thesis.
Okay. So since the time is running out and I'm conscious of that, I want to ask one last question. And you have captured some points of it earlier. When you are evaluating a fund, what are the top criteria apart from the strategic topics that you already discussed? So what are you really looking for
Yeah.
in a fund manager?
For in one word, it's replicability. That's the one thing. So obviously, you kick out all the funds that have never done good performance. So if it's a bigger fund, it has to do 2x net. If it's a smaller fund, it has to do 2.5x net. That already narrows the pipeline down very nicely. I mean, you have to see everything. Like, we're very slavish on making sure that we see basically everything in the market. We really want to make sure we have as many GP relationships as possible, just to make sure that we're informed and to see everything. So, performance is the first thing, but then performance is fine. But if what we're really slavish about is replicability of that performance. So that comes into multiple things. On a structural level, it means that you want to see a kind of even Pareto MOIC distribution. So I don't want to see a bunch of zeros and a bunch of 20x's. I want to see as even as possible MOIC distribution, 2 to 3x's on average, kind of across the board. Because then that shows that their process, whatever they're doing into these managers, is replicable. Obviously, that's backed up with then a human capital strat. You want to see what the operational team does. What are they doing in these companies? Are they growing EBITDAs and growing revenues, or is it just a pure sort of arbitrage play?
Okay.
And then, who is doing these deals? It's wonderful if you did a bunch of 10x funds, but then if everyone who did those 10x's has now left, I'm not buying the same product anymore. You need to understand how defensible it is, that the previous performance in terms of that replicability of the human capital set. And then, it's all, I think on every level, it has to be about replicability. Is it just one or two positions that are dragging the performance up? Or is it something that is evenly spread across the whole portfolio? And then that goes all the way down to performance metrics of the portfolio companies as well. So in one word, in every data point that we analyze out of the sort of 50 data points that we analyze, the main question we ask ourselves is this a replicable strategy? So you need to talk to everyone at the fund, basically from the intern to the managing partner. You need to understand that they're all thinking of things in the same way. It doesn't necessarily have to be a sausage factory, but it also needs to be that there's a playbook that everyone is working on. And if anyone leaves, there's an ability to sort of absorb that and just continue to execute on this strategy, which has become bigger than a person. It's become the firm sort of mantra. So that's replicability, in 100 different ways to look at that is really the key thing that we're looking for here. Good performance is fine, but if you're getting that performance in a way that we're questioning, it's no longer relevant for us.
Awesome. Joel, thank you so much for joining in and sharing those nuggets, insightful nuggets on how you see private markets, how investments are done, especially from a family office driven fund of fund. Thank you so much for joining in today.
Thank you, Rohit. Cheers.
Cheers.